Hello everyone, my name is David Presson and I'm the Director of Investments for Wealth Management at First Bank. Today's video is the first in a series of monthly videos that we're launching to help keep you informed of market events as well as provide some insights on our investment process within wealth management. If you ever have any topics that you think we should cover, please send me an email at david.presson@fbol.com. On this video, I'm going to talk about the steady advance of the stock market this year, along with the stunning lack of volatility around this advance and what it means for investors. Through the first 9 months of the year, the S&P 500, which is a common proxy for the U.S. stock market, is up 14.2%, which is good and not that unusual, but what has been unusual is that the move has been almost straight up this year with very little volatility or downside corrections. In fact, this past month turned out to be the least volatile September on record for stocks, with only a 0.4% average daily move for the month. There have only been 8 times this year where the S&P 500 has moved more than 1% in a day. The least volatile year since 1995, when it moved more than 1% only 13 times. The all-time record was an incredible 3 times in 1963. As the following chart shows, so far this year, big intraday moves have been almost non-existent, with only 8 times the S&P 500 has moved more than 1% in a day. This despite what appears to be a world with plenty of uncertainty, yet the stock market, at least so far, has shrugged it off and has continued its upward ascent this year with a backdrop of one of the least volatile years in stock market history. If you had forecast earlier that the year after one of the most controversial elections in recent memory would be one of the least volatile times for the stock market, you probably would have been in the minority. Then again, the last time we saw a streak of calm like this was the year after John F. Kennedy was assassinated in 1963, once again proving that the market rarely does what the masses expect and usually surprises us. If you notice in this chart, which goes back to 1951, the last time we had a year with only 8 moves of more than 1% was in 1965, and as I mentioned, the all-time record for the least number of moves, more than 1%, was in 1963. Notice that since 2007, the volatility was quite high, but this year the markets remained relatively calm. In addition to the lack of daily volatility, this year the maximum drawdown in the S&P 500 has only been 2.8%, which if it holds would be the second lowest in history, trailing only 1995, which had a maximum drawdown of 2.5%. It's typical in any given year to have several corrections of at least 5%, if not one of 10% or more. Yet we've now gone 226 consecutive trading days without a 3% pullback, the second longest streak in history. If we go 3 more weeks, we'll break a record for the longest streak. So how should investors view this information? Well, at some point, volatility will once again be back. Markets don't typically go straight up without some corrections along the way. We know a correction is looming out there somewhere. We just don't know when, what will cause it, how long it will last, and the magnitude of the correction. But as viewers of the popular TV show Game of Thrones know, winter is coming. And by winter, we mean a stock market correction. As the various characters on the show prepare for the coming winter when times are good, investors today should be preparing for the coming winter or correction in the stock market. The best way to prepare? Have a sound asset allocation strategy that keeps you properly diversified and can help you ride out any potential correction. And as the stock market continues to move up, another effective strategy is to do something called rebalancing. Rebalancing the portfolio means trimming those investments that have moved up and then redeploying those assets into areas that have not moved up as much or have even declined. This keeps your portfolio in line with your original asset allocation targets and keeps your risk levels in line with your regional objectives. If you don't rebalance the portfolio periodically, what you originally intended to be, say, a 50-50 mix in stocks and bonds could morph into a 60-40 stock-bond mix, thereby increasing your risk. An effective rebalancing strategy can also help enhance your returns over time, as you're essentially selling high and buying low as you redeploy some of those assets into areas that are more undervalued. A good recent example of this is the emerging market segment, which is the best performing equity segment so far this year, up nearly 30% after being near the bottom for the past several years. This year, investors are reaping the benefits of adding to emerging markets last year as part of a disciplined rebalancing strategy. The best defense against a potential correction is having the proper stock-bond mix, as bonds have proven to be a great diversifying tool against major stock market corrections over time. Going back to the 1920s, there have only been 2 times when stocks and bonds went down in the same calendar year, most recently in 1969, and the only other time was in 1931. Most of the time when stocks go down big, bonds help to hold up the portfolio and provide a nice insurance policy. While owning bonds won't generate big returns for you, especially with yields low today, they do provide a nice hedge against falling stock market prices and can help cushion the blow on the downturn. So in conclusion, we can't predict when the next stock market correction will hit, but now is the time to prepare for it by making sure you rebalance when necessary and have the right asset allocation mix to help cushion the downside. So if you have any questions or want to make any comments, please email me at david.presson@fbol.com, and thanks for watching.